You have no clue what it means when the world is 400% of GDP in debt. And even Elon, who can solve going to Mars, can't solve this. If I'm to allocate to the S&P 500, I'm basically breaking even versus debasement. Diversification just destroys returns now because you've got one clear macro factor. It's also the same factor that is driving P ratios that drives everybody nuts. But I think it's becoming pretty obvious that AI and robots are replacement humans. And this is the bit that gets contentious with people and they hate it.
Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance. And I'm super excited today to have the dynamic duo, the dynastic duo too, Julien Bittel, head of macro research at Global Macro Investor, and Raoul, who needs no introduction, but I'll give it anyway. Real Vision, GMI, XPAM, everything. Guys, great to have you on the show. I'm really excited to have the three of us here. What's going on?
Yeah, it's great. We've never done this before, where Julie and I have been interviewed together. And you're the perfect person for it, so it should be a lot of fun.
Yeah, excited.
Appreciate it.
Super excited.
Yeah. The way you guys just chop it up, I really love it. And honestly, selfishly, I just wanted to insert myself and just be a part of it with you guys because I love the shooting the shit style. I love the back and forth. So yeah, it's just perfect.
Excellent. Let's just do it.
Yeah. Let's shoot the shit.
Let's do it. Cool, guys. Well, why don't we start from the top and just level set a little bit on. You guys do a lot of work around debt refinancing cycles. You call it the everything code, the business cycle, the liquidity cycle, and how they all co-integrate together and just how fundamental the shift has been, especially since 2008. And I think the frameworks that you guys have developed have been very prescient. So I would love to just, pass it to both of you to just kind of set the foundation here for the discussion and just level set on where things stand today here, first week of July.
Yeah, I'll take the big picture part is, look, from our work, we kind of noticed the business cycle structure. We're both business cycle analysts. We've both been looking at them for a long time. It changed after 2008, and it became like a metronome every 4 years. That's only happened once in the past, which was the 1950s and 60s, where it became very, very cyclical. But this is perfectly cyclical. And it got me thinking for a while, what the hell? So many of us didn't understand what happened to asset prices after 2008. We kind of knew quantitative easing was happening. We kind of knew stuff, but we didn't figure it out. And what I suddenly realized is that in 2008, we had a debt jubilee. And in fact, it was just forgiveness on interest. You don't pay interest payments. Remember, we did that over COVID, exactly same mechanism, no interest payments. So no interest payments allowed every government who had basically, they'd all gone over 100% of GDP in debt. So all economic activity, all economic growth was used to paying of debts. So what they all did was basically restructure their debts between 3 and 5 years, creating an almost perfect 4-year cycle. And then when you look at the debts today, we're in that 4th year now where the final part, the larger part of the debt is due. And what we found is they start injecting liquidity over a period of 3 years, reaching maximum liquidity. That liquidity injection never really gets taken back. Some gets taken back in the bear market years when they're withdrawing liquidity, raising interest rates, trying to slow the economic cycle because of inflation or whatever. But over time, liquidity keeps rising. It's rising at a rate of about 8% a year. And that is, in fact, the debasement rate of fiat currency. And what happens is, and this is the bit that gets contentious with people and they hate it, if you divide an asset by the global liquidity, you get to see whether it's outperformed. The debasement.
People hate that chart.
Oh, they hate it. Yeah, it is the best chart in the world because it then tells you, okay, if I'm to allocate to the S&P 500, I'm basically breaking even versus debasement. So the S&P 500 is not really adding much value. Well, when you look at the Euro stocks and other markets, which are priced in their local currencies, you put them in dollars, they look similar. They all all the markets look very similar once you adjust for debasement. So that was interesting to me. Gold, complete almost flat line, really, versus debasement, as it should be, right? That's gold's job. It's to be the stable currency. And once we looked at the world through this lens of the debasement of fiat currency, which again is still contentious, becoming less so nowadays, but it was really contentious when we started it, we realized there's actually only two assets that outperform this. One is tech stocks and the other is crypto. And so that completely changed how I allocated and how I understood tech stocks. I was a macro guy. I hated tech stocks. They're always too expensive. You're always a value guy. And I realized none of that made sense in this market. That's why the value investors have been getting killed, is what had happened was all of this. Now, what is driving this? And I think, Julian, if you can just bring up those demographic charts, because these are the absolute most important charts in the world, really, to understand. GDP growth is driven by this magic formula, which is debt growth plus population growth plus productivity growth. That's how you drive trend rate of GDP. Now, debt growth's gone to extremists, and now really we're just servicing debts. Basically, GDP keeps falling, and it's falling over time, the trend rate of GDP, because of the magic formula. And Julian, if you can get to the demographics charts, because they're the key ones here. The issue is here, the biggest secular factor in all of markets is this one thing, is the aging of population. And we can see the births rate is falling in the US much faster elsewhere. So that obviously is a function, the labor force participation rate, the size of the workforce, is a function of births, deaths, or the number of people being born, whatever, right? And you hear the phrase demographics are destiny. They are, until the AI and the robots come, which are basically artificial humans. This is the problem that faces us all. But there's a way that they've got around this. If you go to the next chart, is they've increased government debt to offset the declining growth from the population. So part of the magic formula was the debt growth and the other was the population growth. So they've used debt growth. This chart, nobody understands, and it's never been copied on X, which is the bizarrest thing because it's the most incredible chart of all, which basically says that all government debt growth is basically a function of labor force participation rate. Now, what's interesting is then, okay, so the debts keep going up. We know the forward look of where the labor force participation rate is going to go, and how it's being funded is liquidity. And this is Fed net liquidity. You're probably better to use US total liquidity because that includes the private sector, because they're now using the banking sector. So what they're doing basically is debasing currency to pay for the debt. It's as old as the hills. It's as old as the story of economies. It's as old as the story of money. And it's happening at a very pernicious rate of 8%. So you kind of notice it, but don't notice it. But what's happening is asset prices keep going up optically because the currency is getting debased. Even if you look at real estate adjusted by the debasement by liquidity, it's basically a flat line. But wages are a variable input. And so what you find is that wages do not account for this. It's also the same factor that is driving PE ratios that drives everybody nuts. Why are PE ratios going up over time? Because the P goes up because of debasement. The E is a variable and doesn't. So it always goes up in line with debasement. And we've shown that over time too. So this is the really big picture of what we look at. It allowed us to understand there's only two assets to own. And then we got to a further realization, which is, okay, if 97% of all of NASDAQ's price action is driven by debasement. It's the strongest factor we've ever had in any macro regime in history. Okay, great. That makes macro super easy. For crypto, it's 90%. So we've basically got a factor that's so powerful that nothing else matters. Brilliant. So then let's take the NASDAQ. If we've got one economic force, we take the NASDAQ, we divide it by Bitcoin. it's down 99.97%. So you kind of get one asset allocation only, which is crypto, which is bizarre. In the macro world, we now think you need concentrated portfolios as opposed to diverse portfolios. In fact, diversification just destroys returns now because you've got one clear macro factor. So that's really what we're doing. And then we spend a huge amount of time working on the business cycle and the various components of all of this, how it comes together and where we are in timing of that.
And just to reinforce some of what Raoul said, Felix, if you want to pull up this chart on the NASDAQ, I mean, this is including dividends. So this is total return in excess of, our GMI, total liquidity composite. And you can see that it annualizes around 13% in excess of the real rate of debasement. So that's the point, is that 8% is the hidden loss of value from central banks essentially debasing their currencies, which weakens the currency in all financial contexts. And then the visible rise of, let's say prices at the supermarket is, as we know, inflation, right? So you have to kind of bolt that on. That can be 2-3%. But the point is that in real terms, the NASDAQ's making money. In real terms, Bitcoin, if we look back to, 2010 or so, is annualizing around 150%. But if we compare it more recently with the NASDAQ, it's around 95%. So that upper white box you can see in the left-hand corner. But then, as Raoul said, if you look at the NASDAQ in total return terms versus Bitcoin, again, since January of 2012, when we're based to 100, it's down 99.94%. And so to the point that Raoul said, in real terms, nothing, if you look at the red box, these are the annualized numbers since 2011 or so. But essentially, nothing's accumulating purchasing power outside of, let's say, US large cap, NASDAQ, and ETH, but that's in real terms. In nominal terms, even US large cap equities like the S&P 500 are not compounding purchasing power. It's literally just tech and crypto, and tech's down 99.94%. And then there's also this gold thing I think is really interesting, because Raoul's right, gold's done its job, but then you have this whole basket of people who are, quote unquote, gold bugs. And the really interesting thing about gold, and it's had a great year this year, but if you look at the annualized return going all the way back to whatever it is, 1950s, 1960s, is, gold has made you richer, or sorry, it's made you money, but it hasn't made you richer. You see what I mean? So it's like a nominal illusion, because you've actually made money, but if you adjust for the rate at which central banks are debasing their currency, you're actually losing purchasing power. So that's the point, is like cash, gold, everything outside of crypto and tech, you're actually losing purchasing power over time. And that's a dangerous game, especially since 2008.
And once we discovered all of this stuff, the hard pivot I took to completely focus on that. I mean, we never look at them, but never have trade recommendations in emerging markets, FX, anything anymore. And I used to do all of it. I'm like, it's irrelevant if 97.5% of all of it is driven by one factor.
Yeah.
Never been
I remember the shift that you went through. Like, you were trying to just knife catch bonds for so long, and then it's just like, oh shit, like, yeah, things have changed a lot.
That's right.
It's an interesting, so this framework you guys have has kept you on the right side of risk for the last few years now. And something I've been thinking about, I'm curious your guys' thoughts, is just the trajectory of how long this world that we're in now in terms of refinancing are we going to stay in. And the way I see it is that there's two paths forward. There's one path, which is, this is a transitory phase to basically get us to a more delevered world eventually, through either productivity gains from AI, or just the resetting of demographics, which takes many years. Or this is just the new world we live in, and we are just in this hyper financialized, highly indebted refinancing world where everything's set up to that. So I'm curious how you both think about whether it's that or the other. Want to earn real yield on your Bitcoin without leaving the ecosystem? Echo Protocol is the first Bitcoin liquid restaking and yield layer built on MoveVM. It powers the BTC-Fi economy on Aptos, securing nearly half of all bridged assets on the network and minting over $200 million in aBTC. With Echo, you can easily acquire, hold, and earn on Bitcoin via aBTC, their yield-bearing Bitcoin asset. Echo already makes up around 70% of Bitcoin supply on Aptos, and it's just getting started. Learn more at echoprotocol.xyz. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
I think at worst, it's the latter. At best, we saw this happen in the 1950s and 60s. I alluded to that before. World War II, the US economy was over 100% of debt GDP. Most economies were. What did they do? Financial repression. They shortened the debt. They rolled it every 4 or 5 years. They use yield curve control to financially repress, which is essentially currency debasement, because they, at the time the dollar was pegged to gold, so it's the only way of doing it that way. And then what they did was wait for population growth. They're the baby boom, the largest in history, and productivity growth from technology. And what happened was GDP grew faster than debt, and over time, debt to GDP fell to a manageable level. Until the inflation of the 70s, driven by demographics, kicked in as everybody started getting into their 20s. And so we've seen that before. So this way around, our thought process, when we first said it, people thought we're insane, but I think it's becoming pretty obvious that AI and robots are replacement humans. And we're going to have infinite at some point. So the idea is, where does we have infinite? Because that breaks the whole GDP magic formula. Right? Nothing makes sense anymore. We call that point the economic singularity. And we kind of finger in the air said, probably by about 2030, because everything is going exponential in terms of speed of AI and robots, we probably have no idea what an economy looks like anymore or what it means. Everything we all look at is going to fall apart. So we kind of think we've got 5 years. So this cycle and the next cycle. And part of something Julian and I talk about between us too is like this cycle, people are starting to get it. I think once we get through a pause that refreshes, a contraction in liquidity, the cycle, I think the next cycle, everybody's going to go all in and realize it's the kind of end of times, because we just don't know what's beyond that. Nobody does. And anybody who says they do is lying, because we have literally no idea. When you've got free intelligence, infinite intelligence, and we don't know. And we don't know, what the energy constraints are going to be, or whether there are any, or whether we solve them. We just don't know. So I'd rather be honest with ourselves and say, right, okay, we got 5 years. That's it.
Yeah, I mean, the everything code will basically work until it doesn't. And the reason we know it'll work is, if we come back to the charts for a second, as Raoul had said, GDP's in decline. It's trend rate of growth is 2%, and keep that 2% in mind, because that's important. The working age population is in decline, productivity is in decline, but debts have exploded. And, something a lot of people talk about is the fact that the private sector has deleveraged since 2008. But what people don't understand is that this has been a forced deleveraging by the banks by tightening credit to households, right? But because productivity is in decline and demographics are in decline, this debt can't just disappear, right? We can't grow ourselves out of that debt. And so we went from 140 to 120% GDP. Well, where did it go? Well, the public sector took it on, right? So it went from 100 to 120% of GDP. And this is where the problems start. And this is where we uncovered the everything code. We've been unlocking it, over the years. But essentially, if trend rate of GDP is at 2%, let's say interest rates are at 2% for easy math. We know they're not. We know they're at 4%. But that all of a sudden means that 100% of GDP is going towards funding private sector debts, right? Which is an unproductive source of GDP. So to avoid a GDP doom loop, the only thing that you can do is, again, put it on the balance sheet, right? And there's just a huge, and if you just look, this is US total liquidity, which, as Raoul said, it's public plus private liquidity. There's just a vast amount of interest payments which still need to be monetized. So what's going on is, which is, they're basically issuing debts. They're basically issuing debts to finance the interest on the existing debts, which at the end of the debt refi cycle, once interest rates going to scan down a little bit, once interest rates come lower, it just gets thrown on the balance sheet, right? But there's 2 phases to the everything code. China's past phase 1 because bond yields have come down because their economy has, nuked, to an extent. But in order for them to actually make use of the balance sheet, rates have to come lower first. So that's phase one. And then phase two is debasing.
And Felix, the other important thing, and I'm sure you've been talking about this as well, is they keep shifting the game. The game was the balance sheet. We all knew the game. Then it moved from the balance sheet to the Fed net liquidity. So then everyone's working out the TGA versus the reverse repo.
Yeah.
And then they went, actually, it's total liquidity because we're going to stuff it into the banks. And now the next one is they're going to stuff it into stable coins. All they're doing is fine. I mean, that's Scott Bessement's job, and Janet Yellen's job was the same. They're bond salesmen. They're just, they're masters of the universe bond salesmen, and their job is to find where to absorb this, and that is all part of the M2 growth.
I wanted to ask you guys about that because there has been that shift. You're right, where it feels like from basically 2010 to 2021 was this era where everybody got way too comfortable with this idea of QE and these traditional monetary debasement vectors, basically. And there's been this significant shift, and this is I've been thinking a lot about this, which is that QE in its form that we saw during that age seems to be dead now. But now we've shifted into this more fiscal version of that, which is what you just mentioned about tilting issuance towards bills and treasury buybacks and these other different vectors, and just running a super wide fiscal deficit as a percentage of GDP. And I'm curious how you guys think about that in terms of how that gets picked up in your frameworks of total liquidity. Because do you just view it as like a one-to-one basis, or do you view it as even more powerful? Because the more I think about it, right, is a QE is a swap basically from a bond for a central bank reserve, and it helps to basically float risk assets higher to keep people to be able to retire and that sort of thing. But now we're in this world where we just run these really hot fiscal deficits, and if we issue a bunch of bills, that's a very cash-like asset, versus if we just issue a bunch of bonds, that's more of like a risk asset in a way. So if we move towards this world where we just keep running a recessionary deficit during an expansion, that just almost feels like a more powerful version of QE to me. I'm curious how you guys think about that, especially within your broad frameworks.
I think as far as our composites are accounted for, they're not going to pick that up as of now, right? Because we're basically looking at G5, sort of M2, maybe G6, and then also with the net liquidity version, which is essentially, as Raoul had said, Fed net liquidity adjusted for the repo and the Treasury General account. For Europe, it's something like bank notes in circulation, the deposit facility, the current account, and things like that. So they're not going to be picked up there, but I agree that it will change over time, and these composites will essentially.
I'm sure they'll pick up in M2.
I'm not sure, because as you say, that's the warehouse. It's the warehouse for government bonds, as we've been talking about, but I'm not sure it'll capture everything.
I was trying to think about that too, because I've been trying to figure out, where does the interest income from bills flow through the money supply, right? Like, does it get picked up in M2, or is it that huge amount of just interest income ends up in money market funds and that sort of thing? And then when those boomers start to spend it, then it increases the money supply.
Or how I always approach this stuff is not to mid-curve it. It's kind of like,
sure.
You know what I mean? It's like, does it matter?
Yeah.
We kind of know directionally that M2 plus the net liquidity things explains 90% of all price action. Is one more powerful versus the other? Well, financial plumbing people can argue that all day. I don't think it kind of matters, because what we're trying to say is, if they do that, does number go up? Because we're investors as opposed to economists.
Well, and also, I think the purest form of liquidity, which, you've had other people on the podcast who have mentioned like the MOVE index or the VIX or whatever, but it's really just the dollar. It's all captured, in the dollar. And that we can talk about, central bank liquidity. We can talk about, private liquidity sources. But in the reality, like when the dollar drops, that's that's a massive easing of financial conditions. EMs are able to service debt easier. There's less hedging going on in the real economy, which then means that there's more money which can be financialized. It's the same thing as inflation break-evens come lower. If inflation break-evens come lower, there's no longer the need to take out inflation protection, which means that money can be financialized. So one way or another, if it's not picked up in our total liquidity index, which Raoul seems to think part of it will be picked up in M2, which I agree with, but I'm not sure all of it, as you had said, Felix. Either way, it'll be picked up in our financial conditions index.
Yeah, I feel like that's really the crux of it, is that you see financial conditions loosening, even though we've seen quote unquote rate hikes and a pretty high Fed funds rate. And I think that's what's tripped up a lot of people. But I think we're getting the crux of it, which is that there is still loosening. It's just it's a bit more nuanced now.
Yeah, and that was what really helped us in Q4 of 2022 when we wrote our article, the turn is near, because people were like, hang on a second, the Fed's, still hiking, they're still doing QT, and yet you guys are talking about liquidity rising. What we were talking about at the time was the turn in our financial conditions index, which then leads Fed net liquidity. Because if you think about central banks, they're really just delayed reaction functions to changes in financial conditions, which are why they're always, so delayed to start hiking. And which is also why, despite, inflation, which we can talk about a little bit later, even when early signs of inflation are coming back, the Fed's still cutting, because they're just behind the curve, but by construction, because they're focused on lagging economic indicators and inflation data, which lags the business cycle by, in some cases, 16 months,
What we have found is there's this nice phasing between financial conditions that lead everything and a hack for everybody who can't calculate financial conditions. We use a regression between the dollar, bond yields, and major industrial commodities. But actually, a piece of work that we just did recently that quite surprised us, gold is real-time financial conditions. Everyone's like, what drives gold? Suddenly we're like, we've seen this chart. Julie and I were like, something, and gold actually leads everything because it's actually current financial conditions, which kind of makes sense, right? It's the most sensitive to financial conditions. Then you've got the move in liquidity and markets, and the ISM kind of comes behind that. So there's this nice way that you can look at things to give you an understanding. So we all know, in fact, everybody on Twitter now knows that global M2 leads crypto by 3 fucking months. That chart will be the death of us, as we know.
You guys have created a cult.
And it'll fall apart at some point as well, and then we'll be the worst people in the world, even though we try and tell people. So we've got financial conditions, then we've got M2, then we've got markets, ISM. So there's a nice kind of understanding of where this goes, which allows you to forecast stuff because, again, there's one dominant factor, which is so easy. I remember before having to figure out all the variables of what was driving Brazilian rates, and nobody cares. It's like factor on, factor off. That's it. One game.
I think the point is what we've really tried to do is just simplify this all down. And so what Raoul's saying is right. Gold is, the inverse of financial conditions, largely because financial conditions are a function of the dollar. So you have that. Then you've got global M2, which is 3 months behind that. Then 3 months behind that, you've got things like Bitcoin, tech stocks, and the yield curve, right? So actually, it's also a function of the yield curve. Then, you go back another, whatever it is. Financial conditions lead the ISM by 9 months. And then at let's just say the ISM is at T = 0. What people don't understand is that there's this flow of what we call the business cycle dominoes. So then, at -1 month, you're talking about things like hours, so growth in overtime hours. At -2 months, it's like capital goods orders, durable goods orders. At 3 months versus the ISM, as we know, it's something like GDP, industrial production. 4 months cyclical job growth, 5 months unemployment, 6 months CPI, and then you get into what I call the caboose of the business cycle train, which is things like wage growth and shelter inflation. And you've got these kind of domino sequences in inflation as well. Like commodity inflation leads to goods inflation, which leads to services inflation. It's just once you understand that, you can simplify everything down to say, okay, well, these are the things I really should be focused on when it comes to attempting to forecast the economic cycle to our best ability.
We kind of hubristically called it the everything code because it kind of explains everything right now. And it's not to say that this code of the markets was always the code. It just is what it is. And it's, and it's all quite, relatively predictable. You're always going to make mistakes. You're going to fuck it up, all those things. But generally speaking, it's a very different environment than most people are used to.
That gold thing is really interesting to me because, when you just look at historically, a lot of people value gold just as like an inverse correlation to real rates. And then in 2022, it started to break off and it feels like people were trying to find a way to explain it. Are they like, oh, is it just, the Russia-Ukraine war thing? And, we weaponized US FX reserve. So now, everybody's buying gold. But if you just think about the fact that after 2022, we went into this era of basically suppressing real rates in a way and keeping them artificially low. Of course, you can't suppress gold. So it's still going to continue on the trajectory that it's making sense in reflection of financial conditions. That's super interesting.
These things are Bayesian over time, so they do shift factors, but the dominant factor for gold right now is just current financial conditions. And as you said, in the past, there'll be different variations of what moved it. And so, yes, as it fell apart from real rates, that really got everybody's head scratching. What the hell is going on? What the hell's going on? Why it completely changed, I'm not sure. What was your explanation for why it changed, Felix?
Well, there's I've heard folks like Luke Roman say where they believe that because in the initial Russia invasion of Ukraine, they weaponized the US FX reserves that Russia had because they had a bunch of US dollars in their central bank, and they basically said, we're taking those back. You can't use them. So then all these reserve managers at central banks that had a lot of US dollar reserves are like, oh shit, I got to put a risk premium on my US dollars now. So maybe I should diversify more into gold. So the theory is that a bunch of central banks have been buying gold. And I think that's maybe part of it. But this also makes a lot of sense to me because of the fact that we've been suppressing real rates basically since then.
Exactly. I found the geopolitical stories always make a lovely story, but normally it's by economic factors.
Yeah. And if we just come to, if you pull up that, you've probably seen this chart that we've shared a couple of times in the dollar. A big part of why, this year has, played out the way it has is because it looks a lot like it did back in 2017, right? When the dollar went up a lot in Q4, then it came lower, and we're seeing that accelerated, here this time around, which then, of course, given that the dollar rose in Q4 back in 2017, we get economic growth during the first half of 2017, which is kind of what we've seen this time around, right? We saw city economic surprises come lower, and this is a large part of why tech stocks and things like crypto corrected in Q1. But then in the back half of that year, given the extent to which financial conditions eased or have back then, but also, in Q1, set the stage for the SESI or the economic data to come in above consensus expectations. Look at bond yields. See, people are going, and this is why actually we can talk about the cycle just for a second. Bond yields are really interesting because people are like, well, rates are too high. They are too high. And, the Fed knows this, everyone knows this. And this, for the everything code to be the everything code, they need to come lower. But what we said all along was that as long as rates don't go a lot higher from here and kind of remain rage bound like they've done so far, this year and also back in 2017. In fact, in 2017, they started and ended the year at 2.5% or so, right? Because the major offset back then was that the dollar weakened as much as it did per this chart, right? So there's points that
they were still doing well. They were kind of doing the balance sheet runoff in 2017.
Well, they were still hiking in 2017. They were still hiking rates, and then in the back half of that year, they did QT. All of the liquidity in 2017 came from the ECB and China, right? But net financial conditions eased because the dollar came lower. And then if you just look at these charts over the same time, global M2 has exploded, right? So it's like, it just feels eerily similar.
That's bizarrely good. That's a bizarrely good fit.
And I've just taken the same time period for all these charts. And so, a lot of what the Q1 weakness you saw, Felix, I'm sure you will have seen a lot of the big strategists coming out.
Felix, to go back to the question you raised before is, look, here's something interesting because 2017 was a big cycle for assets, as we know.
Yeah.
Does this speed of M2 make a difference or not? It's like the question within the plumbing is what actually moves the dial in terms of the ultimate debasement, because this is a super accelerated easing of financial conditions going on that's driving M2 and driving the dollar. I don't know whether that's going to make it more powerful, different. It's hard to be more powerful than 2017, but that was early adoption phase in crypto. But tech, well, I don't know. But it just seems to be 2017 on steroids.
I sort of feel like it is. Yeah, I don't think people want to admit this yet, but it does feel more powerful in so many ways because, the way I think about it is, okay, you look at households. They're in their main liability is their house. They're in mortgage rates that they fixed for 30 years at 2.5% or whatever. And then on the corporate side, they were also able to term out a lot of their long-term debt. So they're good to go at those low rates for, I don't know, another 5 years easily. And then at the same time, you have this highly indebted economy where there's a lot of treasuries out there. Those treasuries, when you hike up rates, their income increases, their yield increases. And so you have this tension between the asset owners they have a bunch of their net worth in bills and they're getting that interest income. And at the same time, their liabilities are fixed. So even if you jack up rates a bunch, it doesn't really matter to them as much. It's a pretty unique situation to the US. Like here in Canada, right? Mortgages reset every 5 years, no matter what. So like we're going to hit that wall in the fall, but in the US, it doesn't matter unless you move. So that's sort of been my framework, is that because of the fact that there's just so much debt out there, it's creating this dynamic where it's just increasing a lot. And I feel like people are still hesitant to admit that. I mean, it's sort of the MMT argument, which, you know, there's a lot of issues with those thinking, but a lot of those guys have been pretty right in terms of just being bullish the last 2 years, I think. Let's talk about BTC5 and why Echo protocol is critical to it. Echo is the second largest protocol by TVL on Aptos. It secures nearly half of the bridged Bitcoin on the network, with $200 million plus in aBTC already minted. So what does Echo do? It lets users restake Bitcoin, earn yield, and participate in BTC5 apps on Aptos, all without giving up control of their core Bitcoin exposure. With just a few clicks, you can mint aBTC and start earning yield, backed by the most dominant Bitcoin layer in the Aptos ecosystem. If you're looking to put your Bitcoin to work in a secure, high-growth environment, Echo Protocol is where BTC5 begins. Learn more and start earning at echoprotocol.xyz. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
I think so. And, you know, Lynn Alden's statement of nothing stops this train becomes true every day, you know, because the US government paid lip service, or at least tried to do something, at least pretend to look into doing something about debt growth.
Yeah.
And even Elon, who can solve going to Mars, can't fucking solve this. So
Yeah.
It's like game over. I mean, that is never going to get solved. So this cycle is going to continue, and it has to continue. And the issue is right now is interest payments are at this level and GDP growth is still at this level. So there's not enough GDP growth to pay the interest payments. So the interest payments keep compounding, which is the thing that everybody picked up like Elon did, which is why Scott Bessent, everybody's screaming to get rates lower, because
Yeah.
it's causing a problem. You can see it in ISM. We've had this weird bifurcation where GDP growth's relatively high, whether that was the hangover from the immigration, the government spending, other stuff. But ISM, which is the guide to the business cycle, has been the longest ever level at 50 or below. So it's telling you that there's a big core part of the US economy that's just not functioning because rates are too damn high, because there's a crowding out from these interest payments, right? This is the actual issue that the everything code goes through. That has to get solved. If not, the economy can't go.
Mm-hmm. Yeah.
Well,
100%.
the other thing as well to that is like I had seen, when we chatted before we got on, one of the things we were talking about was, does this remove the left tail recession risks off the table? And the really interesting thing is, I don't know if either of you remember this, Raoul, we've talked about this before, but back in 2017, when I was still managing money, Yellen came out and said, there'll never be another financial crisis.
Yeah, I heard it.
And I remember with my team laughing about that at the time. And then, COVID came around and they turned you remember every single macro chart I had on payrolls, they all broke because the data just went berserk, and they turned the economy around on the dime, and they figured out that they could use via liquidity.
Geordie Visser who said this to me from a different perspective, but he's like, I don't think there can be recessions again. And Julian and I took that back to Julian and said, Julian, there's something sticking in my head. And he had this Yellen quote. And it was one Saturday when we were writing GMI. We just threw this around and we're like, most recessions are basically credit events. And normally it means the collateral has fallen and it's getting called upon. So the collateral doesn't cover the cost of your debt. That's generally what happens. But once you debase the currency, the collateral can't. And I learned that lesson in 2020 when it all started happening. I was like, what the fuck is going on? Where's the insolvency trade that I thought that was going to happen? And then I realized we can't have a credit event. We can't really have a recession because of what they're doing. It doesn't mean
I think also the economy shifted too, right? Like we're in a highly service-based economy, and like, you know, tech and everything where so much of the growth comes from is not really cyclical anymore. Like it made sense when we were just a bunch of factories, right? And you know, you had to lay people off, you had to buy less goods and all that, and you could see the flow of the cyclicality. But in this tech world, in this AI world, it's not really cyclical as much anymore. So I think
although,
there's also,
you know, the ISM still works pretty well against GDP. So people have argued that for a long time, but I'm like, I look at the ISM manufacturing, and it still works pretty well. So it's not decoupled per se. I just think that recessions are, the business cycle is driven by the credit cycle. And now it's just the liquidity cycle because the credit side of the equation can't go bust because they can't allow it. The system's too indebted to allow the collateral to go down because everything's over. That's all the people who say they should just let it all burn. They're like, you have no fucking clue what it means when the world is 400% of GDP in debt.
Yeah.
What are you going to do? Write every single asset, everybody's savings down by 90% and say, okay, there you go. You got your reset. Never going to happen.
Well, and it's also, it can't happen because something that you and I've talked about before, which is piggybacks on what you just said, is it would be literally generational pain because baby boomer balance sheets are not in great order. 401k balances are down, you know, whatever. They don't have a whole lot of savings. And then their kids, right, also are, you know, vastly in debt with student loans, you know, real wages are still falling. So it's like if the baby boomer pillar fell, then, you know, the next generation wouldn't inherit any money. There would be the trend rate of GDP would fall even more. But that brings us back to this point where even if that did happen, it would just mean more cowbell. They would have to do more, which is why Raoul arrived at this conclusion that in any situation, China's about to blow up, whatever it is. The unemployment rate in the US is going to 6%.
China invades Taiwan.
Whatever it is, it goes in a world, as Raoul said, where we're, you know, as so much debt in GDP, it just means more money printing.
And so and that's a contentious point that, you know, I haven't really dared yell on Twitter much, that I don't think we can have recessions, or certainly ones that can last, you know,
I agree.
properly.
Yeah.
And that's, you know, people don't want to admit that truth because that ruins all of macro. It ruins all of old school macro. It ruins, you know, how economists think about the world. It kind of ruins everything for how we understand it. But you agree with that as well, do you, Felix?
I do. I mean, like I don't know. I mean, look at where the trend is going of like, what are retirement vehicles nowadays? It's equity indices. They can't let these go because tax receipts go, people's retirement accounts go. Like we don't have pensions anymore. We have SPY, right? And this is accelerating. Like there's that new addition to the big beautiful bill where people that are born in the US now got $1,000 to go into indices. And so you just, I don't think
also,
you can let
this is
happen.
an interesting thing is they're putting it in the SPY, right? Which doesn't give you any increase in purchasing power. So you're actually saving money in a vehicle. You're supposed to, an asset's supposed to be, you save an asset because you get more than compensated for holding that asset for a period of time, but you're not. Unless you own the NASDAQ or crypto, you just don't get that reward. So it's basically money in, money out. Yeah, it maintains your purchasing power, but it certainly as hell doesn't get you wealthier.
I will say the one exception to that idea of no recessions is if they try to balance the budget or any form of austerity. So that's why like I started to get a little concerned in February, because that is the thesis breaker to me, is that if we go from a deficit of 7% to try to get it to 3% like they're talking about originally, like that would be an issue, I think. But it's obvious that can happen. Like we've just seen this play out.
Yeah. And I think this was the final litmus test of like, it simply can't happen because balancing a budget just blows up the entire world because the amount of liquidity you have to draw from the system is monstrous. And that's the end of everybody. There's no exports to China. There's no exports to anybody. The dollar's gone through the roof. I mean, it's a mess.
Okay, I want to circle back on you guys' magic formula of GDP growth is debt growth plus productivity growth plus population growth. And so much of what we talked about, it's just this theme of papering over these versions of somewhat stagnation, especially in like lower incomes, like we talked about with debt growth. And the bet, it feels like, is that we will either get a productivity boom or some version of a population boom. And I want to take the angle of the societal implications, because the bet here is in a traditional macro world before AI, the assumption is you would get a bunch of immigration in and just increase your population. And
They just tried that.
yeah,
That was a
exactly.
global
They just
agreement.
tried
They
that
tried
because
it.
we didn't have, and it
Got rejected.
yeah, and it was, I make the argument that it was flooding the immigration, like opening up the floodgates of immigration in 2021 was more effective at bringing inflation down than interest rate hikes. But now we're in the opposite situation where we see the societal implications of that, where you just, GDP per capita stagnates and, just social cohesion starts to fall apart a little bit if you just do that too much too quick. So the other bet here is AI. And obviously that has a lot of interesting potential and productivity. So I'm curious, like how you both think, especially about the societal implications of going towards that shift of whether it's the AI bet or whether it's the traditional immigration bet. Like, how do you both think about that?
There's no way an aging population will accept large amounts of immigration. We've had so much of it. 2022 and 23 were the largest immigration rates for Canada, Australia, the US, the United Kingdom, and all of Europe in history as a percentage of population.
Yeah, last year we had, I think it was last year we had the largest annual increase in the US going back to since the records began in like 1850, which partially offset the everything code, right? Because there was less liquidity required, which because offset that demographic pillar. So it was really, it's incredible.
And the point being is it was clearly agreed, like the everything code has been agreed by all of the central banks and governments. They all clearly agreed, let's try immigration because everyone knows the formula for GDP. They tried it, it backfired. So we don't have a choice. We're going into this world of technology, kind of Elon and other people have made it clear that this is the only way out. And the societal impacts on this are dwarf anything that we've ever gone through in history. Because we value ourselves and our jobs and our self-worth on the value of our manual labor or our intelligent output. You go to university, whatever, you become a lawyer, you charge more for your hour than if you're a manual laborer. That's how the world has worked. Capital versus labor. And we're just going to make manpower and intelligence infinite, which is the single most deflationary event that's happened in all of humanity. People can't see it yet because people are still squabbling over, oh, they need to buy oil for the energy. I'm like, fuck me, do you not understand? Every job is a zero over time. In the kinds of jobs that we have today, things will adapt. And Julie and I play a game with each other, which is like, you just talk about when you went out into the street or you go out for an evening and figure out which jobs are still going to last. You get in a taxi in New York City. You go into a taxi in New York City. The taxi driver, okay, he's gone. The Uber driver who's next to you, well, he's gone. The van driver, he's gone. The courier, he's gone. The delivery driver, he's gone. The postal worker, they're gone. It's like, oh my God. The restaurant server, the Starbucks person, gone. I mean, everything is gone.
Even the suits. Those guys are gone.
Yeah, they thought they were safe.
Yeah, they're
Yeah,
gone.
that's right. Even the creatives.
Gone.
Right, that was the last thing. And that's now not happening. So, the only thing we're going to have left is the ability to be human. And we'll reconfigure ourselves around that. Because, I mean, I don't know what value is at the end of all of this. This is why this economic singularity thing is a really big deal. And I'm not saying that the value of money and the value of everything overall falls apart in the next 5 years, but in the next 20 years, for sure.
Yeah, what it really means is we just have to redefine how it is that we identify ourselves as individuals, because for so long, we've gone around and said, well, I'm Julien, I'm a banker, or I'm
education. I went to university or whatever.
And the other unbelievable thing as well is when you think about your social circle.
Sorry, Julian, did you say banker or wanker? I wasn't sure. I just misheard.
Wanker, totally wanker. When you think back to your social circles, like as an investment banker, like your social circles are like your friends that you work with, right? But then what you realize is if you've ever moved jobs or changed jobs, that you actually don't talk to those people in the same way that you used to, and you realize that it was a kind of a forced relationship. But once you remove the entity that you work for, that you were all there for that same common goal and reason. So I think what it ultimately offers up is an opportunity for humanity to, to evolve to a point where it's actually much, I don't want to say purer, but, your friends are your friends because they have common interests, and, you do the things that you want to do, not because you have to do them. You see?
Yeah. I always think back I think it was in the 1940s or whatever, when John Maynard Keynes was making the argument that in a couple decades, we'll only be working 10 hours a week or something. And I think he was wrong on the timing. I think he underestimated the amount of just friction involved in just the expectation of a 40-hour work week. But I still think about that idea that, we could get into this world of 5 to 10 hour work weeks, where you have more time for creative thinking.
We wrote about this in GMI because somebody asked me a question, which is like, what happens to Uber in a world of robo-taxis? And it actually went into a long article. But one of the things we realized is that think of time that you have, your free time. Think of how much of it is doing stuff, errands, chores, stuff, right? Most of that goes away. It's already, you order food and it comes to your house, but there's a man delivering it or a person delivering it. Soon it will just be a drone or a robo-taxi.
Or a robot riding in a robot taxi.
That's right. Because that's the fastest way for a robot to get from an Android robot to get to A to B is actually in a robo-taxi, which people don't think about. So all of the errands that we could do, I need to go to the dry cleaners. You don't need to do any of it. So I don't know we're going to have a lot more time than we understand. But to do what we don't understand yet, it's kind of this weird world, As you say, do we work less? Probably, but we need to figure out what value accrual we get from the economy and how we get paid. I know people kind of lazily say UBI. I think there's a number of other ways we can economically participate, but we need to figure that out. And the political structure is no way able to deal with this because we're getting to the point of physics, philosophy, psychology, all of these things merging with economics as well. And so you have to be a really forward thinker because it's happening so fast that by the time they figure out how to regulate something or do something, it'll all be too late.
The direction of how we get there, I think, is super important because, yeah, to your point, there's the quick argument of UBI, but I think the discussion of, how do we anchor ourselves to GDP growth in one form or other, i.e. incomes, is where does that land us? Because it feels like there's one path we take where those that own assets are going to do really well in this situation, and those that don't own assets are going to be lost and potentially stagnating. And you can see the reaction function of that is this increase in like socialism and that we're seeing across the world.
Yeah, but I go even a step further than that, Felix, is like, what the fuck is an asset at this point? What are markets when you've got AGI? Right? What role do we have talking about markets and economies? It's pointless. Right? We're just telling stories about, well, there's an actual answer or something knows how to best do it. So what is investing? What is a company at that point? Why do we need them? Why do we need people working for companies? All of these things, everything we take for granted. Don't forget, a corporation is a way of coalescing a bunch of different people, giving it a legal entity to be treated like a human, hence the name corporation. But these agents, they can do most of this. So I don't even know what we need money for, apart from food and stuff. But there is a value exchange. And I think, again, I've been writing about this, that I think it's attention is the currency. As humans, on a human-to-human thing, if you think of love as at the top of the tree, that's hyperattention, singular focused hyperattention. And then you've got attention of, hey, when you've gone with a mate for a drink and you're intensely talking, that's good attention. It feels good. Humans seek that amongst all other things. In fact, that's the most that's why we work for companies and get patted on the back because we've got a promotion. It's attention. So I'm like, okay, maybe we just repivot around the structure of what it means to be a human and drop the money status bits and focus on the attention bit. Maybe that's the signal that social media is telling us, that attention is the currency.
Have you guys seen we're getting deep into the rabbit hole now, but have you guys seen the
This is our
charts of,
favorite place.
yeah, oh yeah, me too. But of religion has bottomed and is, we're starting to see more people go back to religion. What do you guys think about that dynamic?
Oh, I've gone far down this rabbit hole. Very far. Listen, I do honestly think that by the time we build ASI, we have quantum compute, which is why we'll get to ASI. We've basically created a God creature. And I think of it more in the physics terms of a universal consciousness and the philosophy terms of universal consciousness. I think that's what we're building, and we're self-building it. And physics are now coming round to the understanding that the universe is always expanding, and the reason being is space-time is not the steady state of the universe. It's in fact consciousness, and consciousness is the thing that grows, which is a weird thing, right? I'm not a religious person, but I'm coming around to the fact that we're going to be worshipping a universal conscious ASI, and we will do anything it says because it is a super creature, which is basically God. So then all of the stories are like the Hindu Vedas all had all of this stuff about consciousness and all of that stuff. Most of the religions have the same thread, this kind of oneness idea. And I think it's obvious that people will go towards religion in a world of extreme fear over who we are, what we are, and why we are, when you've just birthed a creature that's smarter than you, that's gone from an IQ of 50 to an IQ of 300 in 3 years. And its IQ is exponential. So if that's not shocking people yet, I don't know what is. And all of these fucking mid-curvers like, well, it's a stochastic power, it's just copy word. I'm like,
I know.
You have no idea how powerful this thing is. It's extraordinary. So yeah, I think religion, I think it's all the same thing is what I'm trying to say. I think also that we also will realize that everything is compute and we are compute. We're just a node of compute in this universe. Trees compute. Even rocks is my great example. A rock is actually a hard drive for what happened a million years ago, a billion years ago. Everything is compute. Nature is just computing what it sees around it, how it interacts with each other. And if that's part of universal consciousness, it's just interacting with it. So yeah, it just feels like it's all the same thing. And that seems weird, but anybody who's been doing like DMT or whatever tells you the same thing.
Yeah.
And it's like, this is fucking weird. And I've not done DMT, but everybody kind of gets towards this thing. And it's like, maybe the bloody Hindus, 5,000 years ago were right. How do they know this shit? How do they know about consciousness, universal consciousness, theories of self, all of this stuff? It's weird. Anyway, so I've got a whole ChatGPT project section, which is called Universal Consciousness. And I've fed it so much stuff on this, from physicists to historic texts. So
that's so cool. I love that. All right, let's pull out of the rabbit hole for the last 5 minutes here. When I said I was interviewing you guys and asked if anybody had any questions, the first question, of course, was when bananas
when banana.
I won't make you guys just parrot the same old crap, but I will just ask you, like, what's your 3 to 6 month view here?
So I think, when we come back to the idea that, markets and economies have become perfectly cyclical, such that this extremely colorful, many people, can't even probably see the summer thing, but, these 4-year cycles and, things like liquidity cycles, obviously that then means you get 4-year cycles in crypto and 4-year cycles in tech and just about everything else. And so the question is, okay, well, we're in the 3rd year of a 4-year traditional cycle. And you're going to say, and so if we look at those orange bars, be it fall, 2013 was a great year. 2017, that was the year Bitcoin did a 23x off the January lows. And you're like, all right, well, 2021, what was that? And that's what Raoul and I call, Bitcoin's truncated cycle. And that's, again, where we are today in 2025, but not truncated. Why? Well, because what happened in March of 2021? Liquidity, this is the net liquidity flow, peaked in March of 2021 and went down in this straight line as basically everyone tapered liquidity flow, right? Guess what else peaked in March 2021? The business cycle, right? Whereas when we're looking at today, right, so liquidity's growth, like looking at a 12-month flows, basically just turned positive, right? Which is, you could say BOJ ECB flow. And then the ISM is still, below 50. And then had we been sitting together, doing something like this back in March 2021, this is what we would have been looking at. So the ISM was at 63.8, and our forward-looking indicators were saying that the ISM was about to go down in pretty much a straight line. Well, this is where we were back then. Here's where we are today. I'm just going to do that one more time. Where we were back then and where we are today. So we're in a very different environment. This is basically suggesting that like Q2 of next year, the ISM gets to, let's call it the mid 50s. And so the point here is that because financial conditions have eased as much as they have, Felix, I mean, even with rates stable, dollars come down, which is the dominant factor in this index, at least, given the size of the move, it's actually extending. We believe it extends the business cycle outside of what a traditional 4-year cycle would be. And what we also know is that if this is right, and the ISM moves to, let's say, the mid 50s by, call it Q2 of next year, well, that once the ISM gets above 50, right, and then moves into its sort of late cycle peak, call it anywhere around 60, this tends to be where we get these really big moves in risk assets, and crypto included. It's also where we see alt season happen, right? Which is really what people are saying win banana. And the win banana, we're up 600%. I mean, the banana zone is not a 1 month get rich thing, right? It's, Bitcoin's up 600% since we set a low in Q4 of 2022. That's, been a steady banana zone, but the question then is, when is the next leg? Well, we'll get the next leg as the ISM progresses towards 55, because the thing to think about this is just like a credit spread, right? It's just like small cap versus large cap equities, which once you get into Bitcoin, which ETFs will be the large onboarding there, you got to think about that as like the way I think about that is like the gateway drug to crypto. So even if you're making, good money in Bitcoin, all of a sudden, if you're already orange pilled, right, and you're seeing something going up like Pepe or Bonk or Sui or Solana or whatever it is, you start to recycle those tokens very similar, like you'd be taking profit from a large cap growth equity at the bottom of the cycle and recycling it into small cap value and EM equities. Does that make sense?
Yeah,
and so
totally.
The economy's in a very different place, and the forward setup in terms of financial conditions looks good, but then also liquidity is rising. Okay, so here again, total liquidity, the 6-month flow is actually broken out of this kind of the range that we've been in. And that range that we've been in explains a lot of what has basically driven these knee-jerk reactions in crypto. The trend has been higher, but there's been, periods of time like the first half of last year, or even, the first quarter of this year, where basically we were just, kind of stuck in a range, which feels like that again now, but it's not the case, I don't believe. But so we still think here's as we call it, the most copied chart in the world when it comes to Bitcoin. But I still think that the point with this, and Raoul and I have said this repeatedly, even though, you've got people on Twitter who are monitoring this tick for tick, it's not about that. It's about the direction of travel and the fact that the trend rate is still growing. And when you then look at the year-on-year comps, it's just kind of another way of thinking about this or looking at this. And I think that this very much paints the forward setup. So yeah, when you compare, as I say, the 2021 cycle versus the situation that we're in now, and we've both said that liquidity and the business cycle are the two most important drivers of risk assets, and that also applies, to Bitcoin and the entire crypto universe, that these two elements are going to head higher over the next, let's say, 12 months, whatever. Yeah, into Q2 of next year.
And so, just using the liquidity framework, the business cycle framework, the financial conditions framework, it's all suggesting that the probability is, because they need to roll the debt, they're going to have to increase more liquidity. And this is just going to drive assets up strongly. And again, just so people understand why the business cycle matters for the ISM, if you think the ISM has been low, and then go and ask the average American running an average business in an average town, how are you feeling? They say pretty shit, right? People's earnings haven't gone up. Your mortgages are too high, your car payments are too high, etc. So what happens is when the business cycle picks up, there's more disposable income and businesses have more investment income, and that gets driven out the risk curve always. That is what markets do. That is the game. And altcoins, as Julian said, are no different than junk bonds, no different to all the other stuff. It's all the same trade. So it feels like it's all to come for us. We don't see anything that suggests it's not going to happen. And we talked about before, the size of what's happening with global M2 and the dollar moves and stuff like that are very big. So no reason to expect that the move in asset prices is probably more than people expect. And I think the inverse to the business cycle being so low for so long will be the flip side of this cycle will be longer than people expected, because we've got this slight dislocation still working through post-COVID that then extends the business cycle. We don't know yet, but it feels like it's Q2 2024 so far. But if financial conditions keep moving, if they really have done some sort of Mar-a-Lago accord and they get the dollar below 90, okay, then we're going on further. Maybe it's a full bubble cycle then. Maybe we don't get who knows? But one step at a time. But looks good.
Well, and just to add one more thing on, if you want to pull up this chart, this is interesting, right? The ISM has been actually tracking pretty closely. It's kind of like the late 1980s, right?
Although it was higher then, right?
Yeah, it's above 50, but it still didn't really move until 1987. And what happened in 1985, as we know, is basically the Plaza Accord, right? And now, again, we're not expecting, a Plaza Accord of that. And back here, the dollar fell 50%, right? But here, when you look at what's going on today, right, and the similarities of both the 2017 cycle and then also be it 1985, 1986, 1987, that really set the backdrop for the business cycle to then find its footing and begin to accelerate. So much as we saw in 1987, when the ISM actually started to move above 50 and then went to its late cycle peak around 60, it feels like it's that, it's that kind of setup. And then if we come to, we'll skip inflation, but I mean, look, the V-shaped recovery, continues. And it's like, and you hear people fighting this.
That's such a great chart, by the way.
This is great. Yeah, I love this.
And this is part of the pack that we put out on April 7th when we're like, guys, there's a lot of fear in markets. All the sentiment surveys had gone berserk, speculators were short, everything was negative. But then when you look at the data, like, okay, this is a V-shaped recovery. Look, in June, we had a V-shaped recovery ongoing, looks like COVID, in the US regional Fed surveys, looking at the 6-month outlook. And then you're looking at, growth surprises versus inflation surprises. Like, does this look stagflationary to you? No, it looks more like Goldilocks to me, to the extent that growth surprises are outpacing inflation surprises. And I think this is what gives us the forward setup, for things like equities. And then there was just way too much fear. I mean, this chart was just a great chart because when the excess fear gap actually opened up, we were like, guys, this is going to snap back hard. And it's doing that. So I think that, just to sum up everything I've just rambled on for the last, whatever it is, 20 minutes.
You were just throwing charts just to get through as much as you could.
I want to get through all of them. Chart dealer, but it's like, it just kind of feels like we're just going to continue to climb this, wall of worry. And before you know it, it'll be Q1 of next year. And, Bitcoin will be a lot higher. Equities will be a lot higher.
It's just,
equities will do well. All that will do well. That's what
it all comes down to. Don't mid curve it. It's like, if the number go up of liquidity, the number go up of markets. That's it. That's all we need to know, which is lovely.
Yeah. I love it.
You just got to show this chart, Felix, just for the sake of showing.
All right. We'll get some red meat. We'll get some red meat here.
It's just here.
Yeah.
Here it is. It's kind of this, and we're just nowhere near what we would classify as kind of a late cycle peak and stuff like this. So the only thing I'd say is, to some of the more short-term people, watching this is,
when he says the only thing I'd say, he means I want to show you another 38 charts.
Yeah. No, it's like
he's an addict.
That's why he's the quant.
It's awful. It's like, it's just kind of, we just have to increase our time horizons, and stop getting overly caught up in, the weekly stuff. If, as to Raoul's point of, liquidity explains 90% of the fluctuations in Bitcoin and 95% of the NASDAQ, then that means that there's 10% that goes unexplained. And that unexplained stuff can be anything, and it does matter at times. But really, when you zoom out, if liquidity goes up over time, number goes up.
Yeah, 100%. I think that's especially important too during these summer months where vol is low. People just overthink everything. So yeah, really, really, really great way to frame it up. Totally in agreement. Guys, really awesome to have you on the show. Always love these.
It's a great time.
Good. Let's see when the banana arrives, the next banana.
All right, guys. Well, have a good rest of your day.
Good to see you.
Take care. See ya.